Welcome to the Real Estate Reserve Podcast with your hosts, Jason Balin and Ian Horowitz.
What is up, everyone? Welcome to the Real Estate Reserve Podcast. I'm Jason Balin from Hard Money Bankers, and sitting next to me in another office about 30 miles away is Ian Horowitz from Equity Warehouse. What's going on, Ian?
What's up, man? How you doing?
Not bad. A little bit different time slot than usual, but a good one. And I think it's important to kind of hop in around this time because I want to make sure we get as many viewers as possible. Super important topic, not the most sexy topic in the world, but an important topic. We're going to be talking about tax strategies, some new tax codes, some year-end tax prep with local real estate CPA Jeff Cohen. A lot of people know Jeff from Katz and Cohen. He's a local company in Baltimore. And in a second, we'll let him introduce himself. But, you know, like we were saying, accounting, bookkeeping, you know, it's not the sexiest topic for real estate investors to be involved in. But I'll tell you, and I was telling a quick story to Ian earlier related to, accounting is somewhat difficult to wrap your brain around. And I actually failed accounting a few times in college. And then as soon as I got into business, it was all about my own money and I was playing with real money. I learned it very, very, very quickly. And it was exciting. So many real estate investors, all they worry about is the sexy topics like, hey, how do I get money or how do I find deals? But we all work really, really hard for those deals. And we want to keep all of our money and we want to know all strategies in order to, not just worry about top line, but let's worry about our bottom line as well. So really, really important topic and, excited to bring Jeff in here in a second.
Yeah, man, it's a great way to sum it up. I didn't learn how to bookkeep until we had a business, and it took forever. And actually, it was 4 years ago in 2016 on election night, me and Dan actually officially reconciled our books after about a year of not understanding how to use QuickBooks. So I totally agree with that statement. I'm excited to bring Jeff in. Like Jason was saying, it's not a super sexy topic. I feel like we've been doing that a lot recently, but these are a lot of important things that I think a lot of people oversight. I did it my first few years in business. Tax liability is a real thing, and I think it's something that everyone should understand. So let's bring Jeff Cohen in and let's jump right into it.
Sure, let's do it.
Hey,
brother,
thanks for having me.
How you doing, man? Yeah, Jeff, if you could just introduce yourself to all of our viewers, tell us who you are, where you're from, and obviously what you do.
Sure. So my name is Jeff Cohen, as you said, and I'm a partner here at Katz Cohen. We are in Baltimore, and I've been CPA now for about 25 years. Hard to believe. We work with all kinds of small business and individual clients, but strong niche here in the real estate world. Probably started about 15 years ago doing talks at various real estate meetings, and one thing led to another. Now I do, a lot of these talks. I'm a mentor in a local real estate group, and probably 75-80% of the clients here are real estate clients. So we've got folks that are just starting out, one rental property, doing their first rehab, all the way up to people doing stuff nationally, owning property everywhere, different states. Guys rehabbing 10 to 15 properties a month. So just doing a lot, seeing a lot, and that's what I'm here to do, is to try to help the real estate guys save money.
Yeah, and to be honest and open and clear, Jeff is my accountant. We started somewhere else and migrated over to him because he was the real estate expert tax accountant, and we've come leaps and bounds and actually understanding. Does a very good job of teaching you of what you should be looking for. And I think that's something we should jump right into. Coming up the year end. And maybe one thing is a lot of people don't understand maybe the difference between, you have your ordinary income from flipping and wholesaling versus being able, to invest it into an asset, that there is tax liability, between the two. I don't know if you want to get into that or some of the year-end tax planning that some people could do if they did a ton of flips this year.
Wherever you want to start. You want to start with just some new things this year?
Sure.
Okay. Interesting. There really hadn't been any law changes since the end of 2017 affecting the 2018 year. So 2019's taxes were pretty much the same as 18 and 2020 for the most part as well, until the COVID hit, and then the government started putting out all these different new rules and laws related to that. So some people may have gotten the PPP money, the Paycheck Protection Program. I imagine almost everybody got a stimulus check of some sort, unless your income was, really high. A lot of people have a lot of questions about how that's going to work as well. Some people didn't get it, and I get a lot of questions about that. Am I going to get it? When am I going to get it? So there's some issues there really that are important. Real quick, and then obviously jump in and ask anytime you want. But with the PPP money, originally they said it's a loan, and then you can apply to get it forgiven. The question arose: is that going to be taxable income? And originally they said it's not taxable income. It's a grant, it's a loan, call it what you want, but it's not going to be income to you. But then the IRS came in and said, hold up, if it gets forgiven, you're not going to be allowed to deduct the costs that were associated with getting the forgiveness. So somebody who received, let's say, a $20,000 PPP loan and gets it forgiven because they spent it on payroll, they're not going to be allowed to deduct that $20,000 on their taxes, which basically means you're paying tax on it because your income is going to be $20,000 higher. So that's pretty important. And really now, sitting here in November, most people who got the money up front in April, May, or sometime between April and June for the most part, they extended the amount of time you have before you have to apply for the forgiveness to 6 months. And now I have people that are rushing to go get it forgiven. And I'm saying to them, slow down, because if you get it forgiven in 2020, that means your income is going to be higher in 2020. Whereas you could push that to 2021. And again, if you go apply today for forgiveness, no one really knows yet how long that's going to even take. The process, which it could be 2021 before it gets forgiven anyway, but it's something to think about. So that's a pretty key thing that I think a lot of people don't really understand when it comes to the PPP money that a lot of folks got. With the stimulus check, it's really a 2020 item. My understanding is it's going to show up on the 2020 tax return. So they were trying to get the money out to people faster. So they based it off of your 2018 or your 2019, but you could have a scenario where you weren't eligible in those years, but you make less money in 2020, right? Which was really the idea, because some people's businesses many people got affected. And if you make less money this year, then you potentially will still get that stimulus check when you file your 2020 tax return. They're not going to take it away if it went the other way. So if somebody, got it and then in 2020 makes more money and shouldn't have been eligible, my understanding is they're not going to take it away from you and make you pay it back. So you get the best of both worlds in that sense. But it's still out there. It's not something that, if you missed it, that you're not going to still get. So those are a couple of pretty important things.
Sure, and it's a new playing ground for everybody. As sure you haven't really filed. You haven't filed a tax return yet. No one else has either until this upcoming spring. So it'll be interesting. And Ian and I actually did a bunch of shows, and we interviewed a lot of people months ago when this was happening. We were learning firsthand as well as we were applying. So it's all interesting. Let's jump into not a new thing, but I think something that is valuable for a lot of people. And we kind of talked about this. Ian and I talked about this in the past, and I think it got a lot of people's attention related to maybe how a real estate transaction is taxed. Let's say you're a wholesaler or a flipper compared to a rental property owner. Kind of the difference between how the income on those particular properties, if it's rental income or flip income or wholesale consulting fee income, how do they differ? And this is kind of a separate topic, but also kind of put together, and good ways to prepare or organize documents towards the end of the year when you're handing over everything to your CPA. Because personally, we obviously have a lot of entities and a lot of holdings, and we've learned over the years how to cut down our 5+ figure costs to our CPA just by able to organizing things and handling things separately. But the last thing a smaller real estate investor wants is thousands or maybe even $10,000 rightfully due CPA bill. And I obviously know the value of it, but a lot of people's companies, let's say they flip 2 houses, wholesale a property and own a rental property, they can absorb a $10,000 fee. And there's obviously ways to get around that by being organized. So I know that's kind of a 2-part question, but maybe let's kind of jump into that a little bit.
Okay, sure. Yeah. Obviously 2 very different topics there, but on your first question, what are the differences between basically rental type of income versus ordinary type of income? And that's a real open-ended question. There's a lot of differences, but the basic idea between rental and non-rental is whether it's considered passive income by the government or not. So rental income basically by statute is considered passive income, which in a nutshell means that there's no self-employment tax. So if you only own rental properties, you shouldn't be paying any self-employment taxes, which sometimes is referred to as payroll taxes, SE tax. It's basically an extra 15%. It's for Social Security, FICA, and Medicare. So that's what happens if you generate rental type of income. You don't have this extra tax, as opposed to what I'll call ordinary type of business income in the real estate world. So if you get a 1099 as a real estate agent, or if you're wholesaling properties, or for flipping properties, rehabbing them for a living, if that's your intent and that's what you're doing, so then the government looks at that no different than, say, you own a shoe store and you're buying inventory. If you're buying inventory and you turn around and sell it, you're self-employed. Besides regular tax, you also pay SE tax, this extra FICA, Medicare 15%, which if you're employed and you get a W-2, you share that with your employer. In this case, you're the employer and the employee. So you have to pay both sides. That's really the biggest difference. And that's why the folks that are getting 1099 income or rehabbing properties, wholesaling properties, they're paying a lot more tax and a higher rate than the folks that are landlords and renting properties. How do you get around that? You have to make sure that your entities are structured correctly. That's really what it comes down to. If you don't structure them correctly, and this 1099 is coming to you in your name, in your Social Security number, you're going to pay a lot more than somebody who has it running through the proper business structure and can get out of some of those additional taxes. So that's one of the big keys. There's a lot of them, but that's one of the big keys. And really, this is, as you said before, this might be to some boring and a dry topic, but hey, if you're making money as a, like I said, someone rehabbing properties or wholesaling properties or 1099 type of income, or even property management. If you're a property manager, you're also self-employed. If you're making money doing any of those things, now is the time. It's not too late for 2020 to still get yourself and your structure in order so that you can save a lot.
Yeah, that's a big difference between me and Jason. Jason's a lender, and by technicality, most of his income's fee income, and we have a lot of rental properties, so a lot of our stuff is passive income. So we're taxed completely different. And it's always an interesting conversation at the end of the year to say, oh, well, what it look like for you versus us. And that fee income or ordinary income is way different than what we're doing. But yeah, was there another part to that question? Because I was going to interject.
The other part that Jason had brought up was really how to organize yourself, which again is a completely different discussion, but related to bookkeeping and just keeping yourself together. So as Ian said in the beginning, finally got themselves able to learn how to reconcile their QuickBooks files. So, I wanted to give you a little round of applause for that.
Thank you.
It's not everybody that can do it or figures it out. Some of them, pay outside people to do it, or even rely on us to do it, whatever the case is. So, as Jason said, and I'm going to be honest with you, I don't want to have to charge somebody, 5 digits, as you said, for a small job when it doesn't have to be that way. And so if the more organized you can be, then obviously the less time it's going to take to get all the work done, and the more attention your CPA can focus on saving you money as opposed to trying to figure out, where to even start. And unfortunately, I do see a lot of real estate investors. They're not accountants or not bookkeepers, and they don't necessarily have that part organized and together. So where do you start? That's the $1 million question. I mean, obviously, it's easy for me to say to somebody, go get QuickBooks, put all your transactions in, reconcile it, and then hand me a nice, clean report. But I understand most people can't do that. So, you have to dumb down a little bit. If you have one rental property, it's probably not something that you have to go run by QuickBooks and put all that in and try to figure it out and make it work. Even one rehab, if you do one flip during the year, you bought it, we have that settlement sheet, you sold it, we have that settlement sheet, then you're talking about, okay, what happened in between there? You have your holding costs, you have your G&A costs, and obviously your rehab costs. If you can just kind of componentize things in your mind in that way and keep a good spreadsheet, that's one way to do it. And I have people who give me QuickBooks. I have people who give me spreadsheets. I have people who just send numbers in an email. And again, as Jason said, the more organized you are, the better off you're going to be from a fee standpoint. And the less organized you are, not only is it going to end up costing you more, the numbers may not be accurate, and you may not even know.
Yeah, I think that's the piece that hits home the most, is that if you don't know your numbers, right, whether you're in business, number one, are you even in business if you don't know them? But number two, I don't think any of us want to pay the government any more money. And, if you're flipping a house and, it might only be a few bucks, but a few dollars in that sense to get taxed on, that it costs a lot of money, not knowing what you actually spent or what you actually made. And some people, it could be the difference between showing a profit and actually showing a loss. And that's really what resonated with us. And that's why I'm with Jeff. Good luck trying to figure out QuickBooks. It took a minute, but we got it down. But if you can get it figured out, it's well worth your time, energy, and effort. So
yeah, at least the basics of it. And I feel like a lot of people, it's so interesting. All the real estate investors I talk to, they're like, oh, I just let my CPA handle that, or I just let this person handle this, or this person handle this, or this person. And that's fine. And don't get me wrong, but as a small business owner, sometimes you do have to be the jack of all trades, at least understand the basics. I mean, I'm not obviously doing tax prep. I'm not doing the higher level stuff, but it makes financial sense to do some of the basic stuff. And, Ian, we've talked about this many of times of, when you hop into business and you're naive to a lot of things, it's like, hey, you learn this software, you learn these accounting practices, you learn QuickBooks, it's going to behoove you to do that. And, it's not, it's not like a few bucks that you're giving away. It's real money. Plus it's the knowledge base. And, it's nice to have an intellectual conversation with another service professional as well, because, let's say Jeff does, your tax returns for you. You don't even know how to read them, right? You got to do the basics and you got to understand it. And, it's challenging. Obviously, if you're a wholesaler and, you, for the most part, just have income and expense, or if you're a lender, you have income and expense. It makes it a lot easier than maybe owning properties or owning rentals and having assets and liabilities on your books. But, every year, just like anything else, every year, just, learn a little bit more, get a little bit proficient on it. And, that's the game. And you got to treat it as important. It's like, oh, I don't do my marketing, I let someone else do that, or I don't do that. It's like, well, what do you do? Like, as a business owner, you need to understand kind of the basics of it.
Yeah, it's fun. It's fun now for me to look at the depreciation column because that's so powerful to us for what we do. And I think to Jason's point of like even understanding your tax return, and Jeff, this is kind of two-parted, but just understanding what your AGI is, right, and that relates to what you get taxed on, right? And I think we're at the year end. What year end stuff can some investors do to protect themselves if they're going to pay tax, like i.e. SEP or 401ks, and utilizing that? Can you go into that a little bit, like what people could do towards the year end and go with that?
So like I said before, I mean, the first step really is to make sure that everything is structured correctly, because that could be really the biggest savings. Now you take that to the next step and you say, okay, everything's structured correctly. I made money. Now what can I do? And we go back to the books and being organized, because obviously you want to make sure that you're capturing everything. You have expenses, what I'll call that are partial business, partial personal, that a lot of people miss and forget about. So especially this year, where a lot of people are working at home, and you might be paying for computer, internet, or telephone, certain things you might be paying for personally. You want to make sure that you're going to capture a certain business percentage of a lot of that. Particularly this year, there's always what we call bunching expenses. So if this year is going to be higher income than either last year or next year, you might want to make sure to grab as many of those deductions and expenses, charge your credit card. You can pay it later, but you can deduct that this year. And in real estate, sometimes there's other options on the income side, on the revenue side. You can push some things out. If you're going to close on a property between now and the end of the year, maybe you can wait until January. Maybe you're going to do something like an installment sale where you're not getting all the money up front, and in that case, you're deferring taxes. So there's a lot of different things like that can be done on the retirement side. The retirement contributions are tied to earned income. So really you have to be generating earned income in order to be eligible for that, which excludes, unfortunately, some of the rental guys and the landlords. But if you do have earned income, and sometimes you have both, and we can shift things around to make it that you're eligible to get some of these deductions that you may not have otherwise been able to if you have multiple activities going on. So again, these are just different opportunities. So with the retirement side, you can just do a small IRA, put away $6,500, $7,000. You can do what's called a SEP, which is 20% of your earned income. And if you're making a lot of self-employment income, you can set up a solo 401k. Now, solo 401k is really an opportunity to put away a lot more money. There's an annual cap, again, depending on your age. But if you're going to put away $50,000 or more for the year to get the tax deduction, you can do that if it's just you in a solo 401k. Now, that has to be set up before December 31st. So that's also important to keep that in mind between now and the end of the year. You don't have to fund it, but you have to set it up. The others you can set up later if you'd like to. So that's another area when it comes to the retirement accounts. Things that you can do now to save some money. We were talking earlier, Ian, about the cost segregation studies. And so basically you're componentizing your depreciation. So if you have expensive buildings on your books and they're not broken out into pieces, you can do one of these studies and it'll accelerate your depreciation. So there's a lot of favorable depreciation laws out there right now. And with the new CARES Act, because of COVID, they are now allowing you to even carry back any net operating losses. So if you can generate losses, you can go back now 5 years and get refunds, whereas before you had to carry those forward.
Yeah, and that's a real big difference between what we talked about in the first part of setting up SEPs and IRAs. That's your wholesalers, flippers, realtors, fee income guys, versus the rental real estate guys who are looking for cost seg studies, depreciation. What else? We got 1031 exchanges, all those types of good things that put you at a competitive advantage. And that's something I want to ask. I know you started to get into the cost seg, and we've had Jerry Lotz on here and talked about it. It worked out very well for us. I suggest anyone that owns properties of decent value to truly look at it. And utilize it. I know we had a lot of talks back and forth. Well, me, Hadassah, and you had a bunch of talks, Hadassah, someone that works with Jeff, about how we're going to utilize it and not affect our whole portfolio, because there are some disadvantages to it. But really what I want you to get into for some of our newer real estate investors is how depreciation is beneficial when you own rental real estate. I don't know if you need to compare it to anything, but really how that works and what the benefit of it is for investors.
Well, what the IRS says is that when you buy a property, you can't just write off the entire cost. So if you spend $50,000 on a house that you're going to rent, you don't just write off $50,000 right away in that first year. The IRS assigns a life to each asset and lets you take a certain amount of depreciation, a small tax deduction each year. For residential property, it's 27 and a half years. So you have to take the cost of the property, divide it over 27 and a half years, and you get to take that bit of depreciation each year. Now, say your cash flow is even small positive or break even. After you take this depreciation deduction, you might have a loss for tax purposes. And so the idea is to take a look at your whole portfolio, make sure things are being depreciated properly. I see all the time where people just completely miss it and they're not depreciating their property. And you're allowed to catch it up. So there's a lot of rules related to that also. So it's something, as Ian said before, understanding that column on the tax return under the rentals and looking for the depreciation and understanding, where that number comes from, how it's calculated. And then when it comes to lenders, the lenders are looking at the depreciation because they understand that that's not a real cash deduction. It's not something that you spent out of your pocket. You're paying the mortgage principal and interest, presumably, or interest only, whatever it is. But a lot of times, if you're looking for a loan and they're looking at your income, you might have a loss on your tax return. But when you add back all that depreciation, they're looking at it as if you made money.
Yeah, and it's actually a fatal flaw I made in 2014 because I heard the guy that I was working with. He's like, "Yeah, that lady, she can never get financing. She wants to buy more houses from me, but she can't buy them because she doesn't show any money." I was like, "I got to show money. I got to show money. I got to show money." And sure, showing money, you got to look at it as you're paying the government, but you get loans back. But the grand scheme of things, she just had a ton of depreciation. She was actually getting the loans, and I was just an idiot. And I think I screwed myself. But anyway, I'll deal with that, and I've been dealing with it. But a lot of the times, I'm sorry not to get too far off topic, but depreciation is usually because a lot of people don't understand your mortgage payments. You don't get to write off your whole mortgage payment. You only write off your interest that you're paying. A lot of times the depreciation makes up for your principal pay down to offset that number, right?
Yeah.
Yeah.
Exactly.
Ian, should we jump in with anything else related to 1031s or cost segregation, or should we answer Ian Barnes's question real quick?
Yeah, I think before we get too far away from the IRA stuff, Ian Barnes does have a good question on.
And if anyone else has any questions for Jeff, feel free to just comment them below. If you're watching this right now, this is streaming on multiple Facebook pages, LinkedIn pages, some Facebook groups, YouTube stuff like that. So feel free to comment. All right. So Ian's question is, how do you how would he set up a SEP IRA? And obviously you don't know much about him, so that could differ, but I guess on a broad level.
The question is how to set it up?
Yes.
Okay. Well, to set up a SEP IRA, you would either go online, Google it, and many financial institutions will let you do that. Schwab, Fidelity, T. Rowe, whatever, generally speaking, you can go on and set that up. If you work with a financial professional, they can help you do that. Generally, the CPA is not the one that's going to set that up, but should be able to guide you as to where to look. I send clients to people all the time to get those accounts set up.
And the SEP IRA, so that's more for an individual sole proprietor, that wants to. You want to just kind of go and explain that a little bit?
Yeah, self-employed sole proprietor, exactly. And the general number is about 20%. So if you're showing about $100,000 as your net profit from the activity, then you should be able to put roughly $20,000 away into that account.
Right. And that reduces your tax liability, right, by that 20%.
Right.
And that's it. Well, you get a percent of that savings, right? So if you put in that 20 grand in your tax brackets, 20%, you're saving $4,000, right?
That's right.
And what's the max you can put into that a year?
So there's annual limits depending on your age. I believe last year it was 56,000, and if you were over age 50, it was up to 62,000.
Yeah, and for SEP, that's a company with no employees. Once you have employees and you want to do something like that, then you're susceptible, like in Jason's situation, 401k and having a plan for your employees and everything.
Correct.
Yeah,
Correct.
Sorry, Jason. I was going real hard with Jeff because this is like my free conversation with him. I don't have to pay him. I don't have to pay. This is not costing me money. So I'm getting out all my questions, but.
I mean, there's value to your questions. So not everyone has the same setup as you, but there's still value to it.
Yeah. And look, Jeff, we really appreciate you coming on. And I'd like to ask a few more questions. I know a hot button item. Look, I don't care who you voted for. Hopefully the election's behind us. But I know a hot button item was 1031s and stepped up basis. Can you tell us, I guess stepped up basis not as important here right now as much as 1031. But how 1031s can be used to real estate investors' advantage?
Well, 1031 is the code section. A lot of people call them like-kind exchanges. You might hear them referred to as one or the other, but it's the same thing. And basically, that's where you're selling property A, and instead of paying tax, you basically defer it and roll your cost basis into property B. So these really only apply on the rental side. I get that question a lot. People think, well, if I'm flipping houses, so I'm going to rehab house A, and when I sell it, let me go ahead and roll that into house B. You can't do that. IRS says you made that money, you got to pay us on it. You're choosing to use the profit to buy the next house and do it again. That's your business. You could take that money and go on vacation. With the rental properties or long-term investment type of properties, that's where the 1031 comes into play. And the reason it's key, we were talking about depreciation. Say you bought a house for $50,000, you held it for 27 and a half years. You took all the depreciation, the cost basis of that property is now zero. And now 30 years later, you paid $50,000 for it. Now it's worth $250,000. Right? If you sold it, you're going to pay tax on $250,000. If you are buying another property, you can roll that into the next property and basically defer the tax until you sell the next property. So if you held that one for the next 30 years, then you're basically not paying the tax on
that. What's the minimum amount of time? I know a lot of people probably have questions. What's the minimum amount of time you need to hold it before you can you can do a like-kind exchange? And is it based on time or is it based on intent? Like, let's say, you buy a 50-unit apartment building and, the intent is to hold it for a long period of time, but then you get a really good offer in and you decide, hey, the market's hot right now, I'm going to sell it. Does it, to upgrade to your next one, does that qualify?
Yeah, it's based on intent. So, it's the same thing in flipping, in general. I have people who are rental people and they're doing, that's all they do is really landlord. And then once in a while they buy a house and they say, hey, someone offered me a good deal. I sold it. So is that ordinary income subject to Social Security tax, or is that just what we'll call capital gain type of income? And so if it's, the government says it's based on your intent. So if it's a one-time thing or once in a while, it's a capital gain. So it's the same thing here with the 1031s. Is there a real time frame that I think the IRS would look more favorably on? There's nothing that I know of that's in writing in black and white, but I've heard 12 months. If it's less than that, they may question you.
Well, it's funny because I have flippers that will reach out and be like, yeah, we need longer than a 12-month loan because we want to hold it for over 12 months before we flip it so we get around it. And I was like, it doesn't work like that.
But I've seen that.
Yeah, unfortunately, it doesn't work like that. But the interesting thing is I think the 1031 And these exchanges have been very common lately, or talked about lately, because the real estate market's done very well over the last decade at this point. But a lot of people, including ourselves, have purchased a good amount of real estate over the last few years, and just like that, and their rental real estate has gone up in value. And it's like, maybe now's the time to sell it. And with the proceeds, what do? Because if you're just going to get taxed on it just to go reinvest in another deal, it might not necessarily make sense. But if you strategize it the right way, and obviously, right, it's also got to be at a higher price point property, correct, or a higher asset class, or it doesn't necessarily work.
Correct. If you don't reinvest all the money, then you will pay some tax.
Right. And I think it's a hot button item recently, not only because of what one candidate was talking about it, but prior to that, the current president installed the opportunity zones, and it's kind of similar, right? I know Jeff, we kind of briefly talked about it. I'm not sure if you studied up on it much more, but do you know much on the opportunity zone stuff? Because I'm still kind of lost on some of it. I have an idea of how it works, but I know it's similar to 1031-ish kind of.
Yeah, the opportunity zones were obviously created for those zones in each state that they determined need extra investment and to build it up. And the main incentive was that anybody with capital gains that wants to defer the tax, if you invest it into one of these zones and you hold it for a certain number of years, then we'll let you defer the tax on that. Once you make the investment, the appreciation on that investment could also become tax-free as well. So that was the idea with the opportunity zones, but you have to hold it for a minimum of 7 years to get a lot of that benefit, up to even 10 years. And you had to really jump in early to get the full benefit. As the clock's ticking, you're already losing out on some of that.
Yeah, I know a few guys that are doing some opportunity zone projects, and they're like, it's just the wild, wild west. Like, I'm like, well, what about this or what about that? They're like, well, we don't know. There's no case studies. I'm like, so you're in this deal for 10 years and you're praying and that there's no other crazy stuff. I know some advantages is you can sell any type of capital gain. So you can sell your stocks and then move it to real estate. And that's one of the advantages. I know a lot of those guys are utilizing that. The difference between 1031 and this is you can get all kinds of leverage and still protect your taxes. And the other thing is, like the guys, I know some of the guys are doing storage. One of the tax laws was that 3 years ago where the equipment, so if you're putting in like a storage facility and you're buying all your boxes or all your garage doors, you can write that off on day one and you don't necessarily need to depreciate it. I forget the tax code for that. Was it 300 or so? I don't know. But equipment, some real estate investors are utilizing that in certain situations. So.
Yeah, there's always the bonus depreciation and the Section 179 deduction. So, but that's not going to work though for your actual property, but that's for your other business assets. Like one of the other questions I get a lot, and back to what you were asking before about year-end type of planning, is how to deduct your vehicle. Right, you're buying a new car, your auto. Should I lease it? Should I buy it? Should I depreciate it? Should I take the mileage deduction? That's an important thing to take a look at also before the end of the year as well. So you could take a nice year one depreciation deduction on a car through like I mentioned, the bonus or the 179. But once you take what they call actual expenses, which is depreciation, your gas, repairs, you can't use the mileage anymore. So you have to determine which is better.
Yeah, no, I understand that. I did have another question that came in just before we came online. A friend of ours, he has a house down at the shore, and he Airbnbs it. The times he's not using it. How is that type of rental income being taxed?
Yeah, the Airbnb is interesting. I'm seeing a lot more of that too. And, I'll tell you, first off, sometimes I see, depending on who you ask, you might get different answers. But the way I understand it and the way I treat it is that it's generally a short-term rental. So if every few days you're renting it to somebody new, that is like a hotel. That's treated as a short-term rental, which again, unfortunately, is subject to additional tax. It's self-employment type of income. Again, if you're a real estate professional and you're losing money on it, then on the books after depreciation and the like, then you can deduct it, which could be a good thing for taxes. But in general, if you're making money doing it, it's not treated as what we'll call a passive activity because of the amount of people that you're renting it to through the year. Now, if it's a property that you're also using personally as well, so it's on the shore, you like to go down there for a week or two or more, then there's a whole different set of rules related to, is it a business, is it personal, how to treat the income, how to treat the deductions. Can you just write off all your interest and taxes, or do you have to start allocating between personal use and business use? So it gets complicated. I'll tell you that some of those people that are doing the Airbnb wanted to know why my fees were higher. And that's the reason, because there's a lot of complication to it as far as figuring out how to treat it.
Yeah, and I guess that brings us to a really interesting point. And I think this is me just talking, but I'd love to hear your take on it. But I always say I pay Jeff because, God forbid, I'm fearful of one thing. And it is, the 3-letter agency knocking on that door right back there and saying you're getting audited. How does that work? Before we hop off here, how does that work? Since you're the accountant or any accountant that you hire, how much responsibility do they have versus you as the actual owner, and where that kind of lies, and the advantage of using the accountant versus typing your stuff into TurboTax and all that good stuff.
Well, I got a call. Well, it's been a while now, but we just wrapped it up. But I got a call a while ago was a referral, a guy who was a doctor who had some rental properties, and he got audited. I didn't do the return; he did it on TurboTax, and he came to the office and asked me to take a look at it. And I think he had 3 rental properties on there, and one of them turned out that it was, quote unquote, his office for his side practice. So he was making a lot of money on a W-2. He was getting a 1099 for some consulting that he was doing. And then he owned these 3 rentals, and one of them was his office. And he was writing the entire property off, everything that he was spending on that property, he was writing off as his office on the rental schedule instead of against his business. And he had no idea really what he was doing. And I noticed as I was reviewing his rental schedule on one of the other properties that he was taking quite a bit of losses. His system was letting him write off like $40,000 or $50,000 worth. And when I was looking at the statement, it looked a little bit like he might have sold it. So we started discussing it, and it turned out that he sold that property. And when I kept looking at the return, interestingly enough, the form that would report the sale wasn't there. And in the end, it turned out that it never did it. He never reported the sale of the property in TurboTax, and he had no idea. And when I went through the calculation with him, he probably had a $50,000 to $60,000 gain on that property. We had a little meeting. I told him what his exposure was, and he was going to try to handle the audit by himself because he didn't want to pay the fees that I told him it would cost to hire us. And probably a month later or so, he called me back and he said, "I give up. I'm not dealing with this." She was literally knocking on his door. She wanted to come to his house and look around and look at this rental that he was calling his office, and so on and so forth. And once they opened up the audit, they audited the entire tax return. So now his entire business, consulting, Schedule C, they wanted to look at everything, show us receipts, and it was a rookie amateur IRS agent too. And she was not budging on any. She wanted every I dotted and T crossed. So I've had that experience. We just wrapped that up for him. And I've also had one that, dragged on for a year, and we sent off a ton of information. Again, a client that we had not prepared the return. And I got a call finally from the Baltimore IRS office and said, why don't you just come down here and let's just try to wrap this up. And when we did, because it was taking so long, they were very interested in just getting it finished. And so it was very easy. I went in there, they gave into a lot of things. I gave into a couple things. We made an agreement, a deal, and we were done. So I've seen that go both ways. As far as who's responsible, I mean, ultimately the taxpayer's the one responsible. It's your records, and you need to keep them correctly. Our job is obviously to ask the right questions and make sure things are presented properly and back up where we put things and how we put them down. But if the IRS wants the detail and the receipts and the backup, that's your responsibility. One more quick one. Also, a guy in real estate who does a lot of rehabs, I think a lot of people know him, came to me out of the blue and said, "Hey, I need your help." He got audited because he didn't do 1099s. So he didn't give any of his contractor 1099s. Anyone you pay more than $600 to for a service, you're required every year to give them a 1099. And he really got slammed for it. So again, there's different things that I've seen, when it comes to audits, and it's important to make sure you have everything organized and together.
Good stuff. See, that's the fun part. These are the best stories.
No, have you ever been in that basement? Literally a basement, that tax office, dude. It is not. I went down there because I had to do a payment plan for a short period of time, and it was it's like a dungeon down there. I was like, all right, I've had enough. I'm out of here. Never again.
Well, I mean, so many real estate investors I talk to, they don't do they're not doing their quarterly deposits. I mean, business owners in general, I feel like this is a business. There's a lot more into a business, especially as a real estate investor, than to go find a property, fix it up, and sell it and keep the money, right? Like it's so many of them are. I mean, I don't know if it's lazy or responsible, ignorant, just not knowing. I think a lot of it's kind of not knowing, but I've always said it's a bad idea, even if legally you don't have to pay it quarterly and you get whatever the small penalty, which isn't, it's pretty minor, right? So I understand on the business side to potentially not pay quarterly and pay it with the fine at the end of the year, but psychologically and organizationally, pay it quarterly. It makes it so much easier. Just makes it so much easier. And so many people fall into that trap, and then they're always, behind the eight ball all the time, right? They got to, in 2020, if they're behind, that means they got to do more stuff in 2021 just to get that tax burden satisfied. And not the type of business that I want to personally run, but we see it a lot as well. Yeah,
I got a lot more stories if you got time.
I might not call. Oh, God. Taxes get at the end of the year. I love talking to you and Hadassah, but I'm always like, oh my God, it stresses me out. But either way, no, we definitely appreciate it. Is there anything that we've been on here for almost an hour? Is there anything that we missed that someone should take home and be like, if you take one thing away from me, take this? Besides, don't get all of it.
Yeah. I mean, there's a lot of things that we could still touch on and talk about. I think to me, the biggest thing, and we did touch on it, is how you're structured. That's the number one thing that I find that can really help you and save you money, especially if you have multiple activities going on. So if you're renting properties and you're also, rehabbing or wholesaling or whatever the case is, any of those types of ordinary income types of activities which cost more money. I've had a lot of cases where we set up multiple entities and we're able to save quite a bit. So, I think those are really important. The retirement planning is important as well.
Yeah, that's
in the book, organizing the books.
Yeah, I can definitely attest to one of those two comments. Jeff, what's the best way if someone wants to talk to you about entity structure, tax planning? There's still time for the year end. What's the best way to get a hold of you and get in contact?
Sure. So you can obviously jump on our website, which is www.katzcohen.com. Our phone at the office is 410-480-4900. And that's just as good a way as any.
Excellent. I just chatted that in the comments here, so it'll show up in this feed. So that'll be helpful, and then I'll just put it right there as well.
My email address is just Jeff@KatzCohen too. It's real simple.
Jeff@KatzCohen. Perfect. Well, we certainly appreciate you coming on. We had typically it's nice. We usually get a few thousand watches and views on these live shows. And the good part is we do them live so everyone can watch them in real time. But then after the fact, they stay around on all of our Facebook platforms and our YouTube platforms and things like that. So if anyone has additional questions moving forward, either reach out to Jeff directly or, continue to comment on this feed. That's always another good option.
Thanks for having me. Let's do it again.
Absolutely. All right, guys. All right. Take care, guys.
All right.
Thanks for tuning in to the Real Estate Reserve podcast. Do us a favor and like, comment, and share our broadcast. It helps the algorithm and helps us spread the word too. Till next time,